It's Friday, September 12th, 2025. My name is Dano, Weir, host of On the Markets. I'll be joined shortly by Daren, Blonski, and Chris Sipes. Our show, if you're new to the show or perhaps you're a frequent listener, our show is a market show, but from time to time, political and global events rise to the level that impacts the market. This week, the death of political commentator Charlie Kirk and the gamut of reactions therein definitely dominated the conversation. If you're looking for a heated discussion on that, that's not hard to find anywhere else. This week on the show, we first just wanted to acknowledge, obviously, that it happened, and then look at how the market basically didn't react to it in a negative way, at least. That, among many other economic factors, also under the hood, could have easily coalesced into a narrative for a downturn, but that's just not happening. So why might that be? We'll try to answer that and more this week on the markets.
The stock market, the economy, your money. What's the latest and what could be next? Find out now with Fermata on the markets. Straightforward financial market updates for the brands of Fermata Advisors, Sonoma Wealth Advisors, Fermata 401k, Fermata Tax, and Fermata Insurance. On the markets starts now.
All right, Daren Blonski, Chris Sipes, myself, Dano Weir. Chris, I'll start with you. There's just, and I remember this growing up, you know, there are things that happen in the world, and I just have a really strong memory of, you know, Princess Diana dies, or there's a famine, or there's, you know, a tornado, or there's events that happen, and they kind of have nothing to do with the market per se, but all of a sudden, it, you know, seemingly causes the market to go down. Am I misremembering that, or in your time in the business, Chris? Is that kind of have been the case many times?
It could be, Dano. I heard someone saying this once, that maybe like up to half of our memory isn't even real, the way we remember things.
Yeah.
And I guess in some strange ways that's comforting, because for bad memories, you can just choose to think, hey, maybe I'm misremembering that and the way it really happened. But yeah, you know, given that this week was the anniversary of September 11th, you know, for me, I definitely remember exactly where I was, you know, when you heard that news, watching that on TV. And I think more importantly, how it felt like there was kind of a before that and after that feeling to things. And, you know, by that time in the markets, a lot of the air had been let out of the .com bubble by 2001, but it sort of marks kind of the end of that era in some ways. So it's too early to tell, you know, with this one, but it definitely was a crazy week. But to lighten the mood for a little, had someone graciously say that they enjoy watching our shows, and this person actually said they liked our dad jokes.
Wow.
Believe that.
Holy.
So
Level there.
I've got one for you. And this is from a website called Country Living, and they've got 300 dad jokes. So there's a nice supply. But do you guys know what kind of shoes frogs wear?
Got me.
Open-toed sandals. I think, as my kids would say, that's a bit cringe.
Yeah, but it puts a smile in the room, Chris. So thanks. We could probably all use it, I think, maybe at the end of the week. I wish we could put a smile on some of our consumer and investor sentiment, because looks like things not so. We're seeing, what are we seeing this week?
Yeah, you know, it's interesting, because the market's you know, up on the week. However, the sentiment indicator, which comes out every Thursday for the AAII members, and this is just a question, you know, are you bullish, neutral, or bearish on the market over the next 6 months? The bearishness has risen up to 49, which is, you know, pretty significant, given that usually it's around a third. We saw the bearish high in April, on April 2nd, for the 1 year bearish high. It was up at 61. Now, the reason why we look at this is to see extremes, and knowing what you know today, if you look at that extreme bearish sentiment in April, at least where we're at so far, hey, that would have been a pretty good time to be invested, given that so many people were bearish, at least so far. So, not necessarily an extreme yet this week, but heading that direction. Now, if we look at the CNN Fear and Greed Index, which is at 56, just barely tapping into the greed zone this week. Now, that one is based on actual positioning within the market. They have seven different indicators that they look at. And then we've got Bitcoin, which I'm sure we'll talk about a little bit later. It looks like it peaked up above its 50-day moving average, which that is at 57 greed, which is up slightly from 48 neutral last week. And so the vibes obviously follow price. And, we had a little bumpy start to September in the stock market, in the Bitcoin market, but, mid-month here, we're doing pretty well. It looks like, oops, sorry about that. So one of the big pieces of news that we got this week was the massive revision to U.S. payrolls. And this is from the BLS. They reduced their March 2025 payrolls count by just a cool 911,000. Whoops. Last year we had the 818,000 job revision in 24. So we topped that in 25. I believe this is the most since 2000. And so it's interesting. We talked about this last week, how every jobs number everyone's hanging on every single jobs number. And then we get, a year down the road and go ahead and revise away just, a million of those jobs. So like, it's interesting that we hang on that so much when the number is likely off by a lot.
And so just so we're clear about what we're looking at here, the BLS, the Bureau of Labor and Statistics, they provide these jobs numbers and say every quarter, right? Is it every month? One of the two. They give a report to the president of the media and they say, we added 600,000 jobs. And then they've been having all these revisions after the fact. And so this was her name escapes me, but she was recently let go by President Trump because of how many revisions that she had submitted. And you're saying that this most latest revision from the new director is revising the 2025 numbers that down 900,000 less than what had been reported.
That's right. And as you can probably expect, the market went down on this information that so many more jobs were lost that we didn't know about previously. Right? Wrong. The market rallied.
Right. So speaking to our theme to this week's episode, this is a perfect example right off the bat of economic data that, this would have been a perfect narrative, Daren, to what you've been talking about, which is a fall, a September crash smackdown, where it's like, oh, the jobs numbers are wrong. Boom, here it goes down. And the market just isn't reacting that way, is it?
It's not, which is interesting. So I think what a great example of, hey, there's this seasonality thing. And at least so far, we're only 12 days into this one, but we still got the back half of the month here. We haven't seen a pull down in the stock market, which you typically do get in September's. And you certainly have gotten the data to suggest that, that might be reasonable response, but we're not seeing that yet.
So as we'll see in a few, the market's still expecting a rate cut in the September meeting, the September 17th meeting. And right now that is expected to be 0.25%. And what should we expect from the S&P when rates are cut? Well, it's a mixed bag, and it really doesn't seem to have a correlation or a causation in the market, meaning that the market doesn't tend to do better or worse. It really is kind of at least for the stock market, it doesn't matter as much. And that, I think, is probably even more so these days with the large U.S. S&P 500 companies being very well capitalized. A lot of them don't even have any debt, so higher interest rates don't affect them in the same way that it might have affected companies in the past. So, in terms of your stocks, now your bonds might be a different story. Bonds are probably going to could react positively if interest rates actually go down. Because remember, the Fed only controls the short-term interest rates, and the market controls all other interest rates, basically all the rates that matter. And so it's not necessarily just the case that if the Fed lowers rates on their side, that the market follows and all rates go down. Now, one reason that could be accounting for the continued strength in the U.S. market is that we've still continued to run trade deficits and fiscal deficits just like before, which is probably not what most people would expect. This is from Charlie Biello at Creative Planning, showing the U.S. trade deficits in goods and services. We hit a record. So, despite the tariffs, despite the changes in policy, at least so far in the first 7 months of 2025, we've exceeded those trade deficits that we saw in 24. So nothing has really changed on that front. In fact, we've actually increased those deficits. And the same thing with the debt. This is also from Charlie Biello, showing the national debt since the ceiling, the debt ceiling was increased. And let me just read Charlie's commentary on that. He says the U.S. national debt has increased by $1.2 trillion since the debt ceiling was raised just 2 months ago. And now we're at a point where at $37.4 trillion, $1 trillion doesn't seem like that much. Right? But it wasn't that long ago. I believe it was under Obama. It might have been under Bush. It was under one of those two. We increased the deficit by to a total of 10 trillion. And so, $1 trillion would have been a 10% increase in the debt. And now it's, the larger that ball of debt gets, the more the compounding can take over, right? And so one major reason that the markets have continued to stay on track is the unprecedented fiscal and government deficits and debt that we've been running since COVID. And that works until it doesn't, because as we've talked about before, the U.S. government is one of the largest borrowers of capital in the world. And so going back to my economics professor and how he described it as, you go to the family barbecue and there's only so much food there at the family barbecue. And somebody invited Big Papa Steve. Big Papa Steve comes in and he makes it through the line and he eats, more than his fair share of food. There's a lot less left for the rest of us, right? And the U.S. government is Big Papa Steve.
Why do you have to pick Steve?
We got some clients named Steve. Okay, they're not going to think you're just singling them out.
I am not. I'm not. This is
sorry
a
to all the
hypothetical
Steves.
Person. Yes. Apologies to all the Steves ahead of time. But hopefully you can picture that, right? Is that an interest rate is just the cost of money, and money has a price just like every other commodity in the world, which is driven by supply and demand. And the more demand you have for something, it's gonna all else being equal, drive the price higher. And so if the government continues to amass this debt, it's likely that they have a crowding effect in the debt markets, and the interest rates will have a really tough time going lower when the largest borrower just keeps getting bigger and bigger. All right, so we got the Fed Watch tool from the CME, which anybody can access this, by the way. So if you're interested and want to know what the futures market is expecting from the Fed, we've got a 94.5% chance that they go with a 0.25% cut at this next meeting. And given that that's only a few days away and there's not really many more data points to come out between now and then, that seems likely what the Fed is going to do at this next meeting. So largely priced in. Now, if they don't do that, you would likely see a very large market reaction, given that what was expected priced in didn't happen. But it's widely expected that that's what we'll see at this next meeting. Now, if we look at the last time, and just to illustrate how interest rates can work independent of what the Fed is doing, this is the 30-year mortgage rate, and you'll notice that for one thing, it's been going down recently. We're under 6.5%, so that's a good thing. But also notice September of last year. So that'd be the data point between the July 24 and the January 25, kind of the low point. That was when the Fed lowered rates by 0.5% a year ago. And you'll notice that after that, the market for mortgage rates actually went up. And while it's still in this overall, kind of consolidation area, it definitely did not matter that the Fed lowered rates, because the market went ahead and just raised rates on mortgages. And when I say the market, I mean, investors all over the world that buy this debt, and they are pricing that debt and what they expect for a return in exchange for the risk that they're taking. And so the market is pricing that risk higher, or it did. And so just because the Fed goes into a rate lowering cycle, it may not flow through to the things that matter, like credit card rates, mortgage rates, car loans, all the things that people use money for, business loans, etc. It's not necessarily a lock for lower rates there. Okay, so going back to how will the market react to lower rates, and we already talked about, just historically, there's not really a huge correlation between interest rates and future market returns when talking about the S&P 500. We've scoped out, based on most of the valuation metrics that you look at for large cap US stocks, they're expensive. And roughly they've only been more expensive one other time in history, which was during the dot-com bubble. And you can see that here. That's that spike in 2000. We got up to about 43 on this CAPE ratio, which is the cyclically adjusted price to earnings ratio. They smooth out the earnings over a 10-year period to kind of take out some of the noise. Now we're back to where we were at the end of 2021, kind of at maximum hype around, opening things back up and, stimulus. Everybody had money, et cetera, et cetera. So we're fairly expensive. That's one takeaway. So we're at 30, call it 38. The only other time we've been higher than this was we got to 43 or 44 in the US. That's one takeaway. Now, people that would be skeptical of this would say, yeah, but if you notice, the CAPE ratio has been elevated for quite a while, which is fair enough. If you look at, really since 2020-ish, the CAPE ratio has been high and going higher. And that could be, a function of the fact that people have given a premium to U.S. stocks, priced it at a premium based on the fact that, The companies have done much better. The profit margins are really high. We have a friendly tax environment in the U.S. around corporations, and so investors have been willing to give a premium to that, a price premium, and based on our reputation, and based on stability, and based on all the things, right? And as far as the American exceptionalism narrative goes, I think that goes as long as it goes, and then it could change, right? And a lot of this price premium is based on narrative and expectations, and something that would shift that narrative, which we haven't seen yet, of course, but something that would shift that narrative could potentially make a big move in a market like the S&P, given that it's kind of priced for perfection at this point.
And to what you're saying here, Chris, part of the American exceptionalism argument is a political stability, and the sense that the dollar's not going anywhere, and the sense that the a military stability, and regardless of how whichever side of the aisle you fall on, I think it's safe to say that it's definitely been a tumultuous time politically for a while, not just this most current term, across several terms, really since COVID. So it's interesting to see this is another instance of the market just sort of is not acknowledging that. And it's just saying, no, we're still good. We're still American except we're still keeping it high. It's just, it seems like another example.
Yeah, it is. There's a lot of reasons like we've discussed. And one that's given a lot of credence right now is the passive indexing kind of relentless bid on the S&P. And what I mean by that is that most people now, invest in passive index funds, and they do so pretty systematically. I've talked to enough investors.
Invest in passive funds passively, you mean?
Yes. And when you talk to a lot of people about like, well, hey, how did you pick your 401k funds? Well, a lot of people just look at, well, what's done best over the last X amount of years. I'll just put it there, right? And so there's been a passive bid coming into the S&P that has benefited because people feel safe given the last, the previous returns and the familiarity with it, and et cetera. So if that starts to change, if people say, you know what, I don't feel as good about it, that could shift the tides of the flows that are coming into the S&P.
I've heard the phrase several times. I'll just put it in the S&P. Just, they use the word just, which almost is like right next to justice, justified. Like it's a simple thing to, I'll just put it in the S&P, which feels fine. And even saying that out loud right now sounds very reasonable. In 2008, you would not have said that. That's the equivalent of saying, I'll just put it in a dumpster fire. I mean, so it's really, it speaks to the feeling around investing in the S&P 500 right now.
Right. The narrative changed at that time and got really on the other side of that sentiment, where instead of a premium to the US market, there was a huge discount to the US market, where people really thought that the market would not recover. And so if you invested in the S&P in the spring of 2009, when everyone was no longer giving that premium and there was a huge discount, the forward returns were pretty good at that point, very good at that point. And so kind of the flip side of that coin. Now, we also got the CPI reading on Thursday, and which was in line with expectations at 2.92%. And you can see on the longer term, we're definitely not trending lower on the inflation numbers any longer. We are at best going sideways. And at worst, you could say, well, maybe we're starting a new uptrend in the CPI and inflation data. And so, the two mandates of the Fed, which are full employment and price stability, really saw hits on both sides this week in terms of we got a very weak labor market number and we got a pretty high inflation number, although the market seemed to be ecstatic about this inflation number. Market rallied hard on Thursday on this data.
Why do you think that is, Chris?
I guess maybe they thought it was going to be worse. I guess people thought that inflation number might be even worse.
Kind of interesting how it rallied so hard. And we talk about this a lot in the show, where it's like the market does what the market does, and then we all look around to figure out why the market did what the market did, and then have some justification or some, it did this because of this. But the truth of the matter is nobody really knows why the market does what the market does. It's this accumulation of all this information and data being digested by all these individual actors with different individual mandates upon them, whether it's a short-term trader or whether it's a long-term low-risk investment institution, and then the market just does what it does. So hard to argue that the market can absorb all of that at once, but somehow yet it does.
And I think it's a perfect example too of, and I'll speak for myself because I feel like I relate to, there's a lot of people like this, which is that I am still new to investing. My part of this show is to sort of be the connection to someone who doesn't know.
Dan has the hot radio voice, so we have him on for his voice.
That's it. That's all I really.
He's great at translating. Like, if you know Dan is amazing at translating and asking questions when he's talking to people. That's one of your gifts.
Thank you, Daren. I really appreciate that. And that's what I was going to say, is that Daren and Chris have so much knowledge and experience with this stuff. And I feel like I relate with, if you're someone listening right now who is still kind of new and is like, wait, is there only 500 stocks? Or, you ask questions like that. There is this sense that there's people on the inside who have inside knowledge and they're making inside moves that you could never make. And golly, if only I knew that the inflation number was going to go up, I could have gotten in early and made whatever short, whatever. This is a perfect example that the number really wasn't that good. And in fact, could be deemed as bad. And the market was like, great. This is a number that you could have felt like you could have made a call on it, and it was actually the exact opposite, Chris.
Yeah, exactly. That's why you gotta you have to invest as if you surely don't know what's going to happen. Right. But B, even if you know what's going to happen, you don't know what the market's reaction to it's going to be. That's for sure.
Right. Because you don't know if it's priced in or not already, right? I mean, like, that's the issue. Like, you don't know. Nobody knows.
Exactly. Now we got the consumer sentiment numbers today, which turned back around. We had a positive uptick last survey, and this one turned back down. And this is one of the conundrums of this market, where you look at sentiment now, people feel as bad as they did. Actually, they feel maybe worse than they did in the depths of the great financial crisis, with unemployment rate is low, net worth is at all-time high, many of the markets are at all-time highs, and consumer sentiment is very low. Now, despite that, people have continued to spend, thankfully. They've continued to spend, which matters, because if you look at the chart from JP Morgan's Guide to the Market, you can see 68% of what goes into our GDP is consumption. So if people felt bad and they also stopped spending, that would be a problem. But the fact that they feel bad and they're still continuing to spend, I think it is really a case of, we've talked before about the concentration of wealth in the United States, where you've got a vast majority of people with really no assets, they're really struggling just to make it week to week. But their spending doesn't have the same impact on the economy as the people who do have assets, who do have income. That's who's really moving the needle. And so, maybe that sentiment is capturing a lot of those people that, their spending is they have stopped spending, at least on stuff that they don't, discretionary spending. However, because they don't have as much of the pie, it doesn't make as big of an impact, right? But our GDP is on track, to be, right on trend again in 25, despite these challenges and sentiment in other areas. And a big part of that is the well, we'll get to that in a second. I forgot about this chart first, which
before you move on to that next slide, Chris, let me just try to put that in another way. What you're basically saying is that the average family is falling behind on their credit card payments, but from a GDP perspective, it's fine because Jeff Bezos just bought 6 super yachts.
Yeah, I mean, I heard his wedding was what, 50 million.
Yeah.
So imagine how many people, like, that's one event. So imagine how many people that covers in terms of spending, know. Right. I don't think I've ever spent, you may not spend 50 million in your entire lifetime. So that was on one event. So yes, that's exactly what I'm saying. Now, this chart also from the Guide to the Markets is the recessions and expansions post World War II. You'll see the one that is at 12.7%. And I would say that if we have to look at, like, okay, if we ever get another recession, if the long-awaited one ever comes, that's been forecast for so many years now, what might it be like? Well, if you look at the post-World War II era, I think it has, or time frame, I think that has a lot of parallels in that. One, we had a massive debt to GDP. We just got done fighting a world war. So our debt to GDP was similar to where we're at today. The government had also been running pretty massive deficits to fight that war. And the economy overall had to come back and shift to a totally different regime, going from a wartime, output to back to more of a normal output. And we've got the debt, we've got the deficits, and I think many would argue with AI coming about and the market, the economy shifting, right, to a 10 years from now, we're likely going to look back and go, wow, we just went through another industrial revolution over the last 10 years. I mean, we've got these what they call dark factories, where they're building these mega factories that use the electricity of a small city or a large city, and they're dark because they don't need to leave the lights on because the whole thing is run by robots, right? And so what is, as we are shifting from our previous way of running our economy into this new economic reality, you would think it's not going to be bump free, but anyway, that was the decline in real GDP at that time. So hopefully we don't see something like that. With the pandemic, decline in GDP was 9.2%. That felt pretty big, and the post World War II one was actually more than that at the time.
Chris, I got to ask you before we move on to the next slide, because we had an earlier slide that went back to the 50s. This one goes back to the 1920s, and you had one that dipped back to the 1800s. What does history help you with when it comes to your investing, when you're investing for clients?
Well, I think what we look to, the trader, and Daren, help me out, I think it's Chris Chavaco. He has this saying that says, like, Why do we look at these things? Because this tells us what people did in this situation previously. And, people's reactions are usually, tend to be the same, right? Over time. And yes, we have different historical events that happen to us, but largely humanity's reaction to those events tend to be similar. And when you're looking at investing, especially taking care of someone through retirement that might be a 30-year span, you can't look at just small time frame regimes, right? Because and you can't look to your own personal investing experience only, because then you're missing a longer term view of what has happened in the past, what could happen in the future, the way people react to things, the way countries react to things. And so in order to be as prepared for a long-term investing horizon as you can, I think you need to know as much about market history as you can to try to dodge some of those pitfalls.
That's what I thought you'd say, but I thought I'd ask.
Okay, so also from the Guide to the Markets,
also like Dan on the show because he pitches lots of softballs at us.
Yes, thank you, Dan. I appreciate that one. Growth drivers. Okay, so soft employment data. Maybe it doesn't matter as much because we don't need to employ as many people, because the people that we are employing, the productivity per person is going up dramatically. So what this shows, long-term growth drivers have historically been growth in workers, so the number of people that are working, plus the output of that person working equals your growth in real GDP. And you can look at previous decades here where, a lot of previous decades growth was actually from productivity, I would say, except for the 70s when the baby boomers hit started hitting the workforce. There you saw a huge growth in workers and not as much productivity gains. Incidentally, we also saw a lot of inflation during that time period. And now you see a shrinking of growth in workers. That number is shrinking, but the productivity has gone up over the last 5 years. And, a lot of that forced productivity happened during the pandemic, where we had to start using technology to make ourselves more productive because we had to, not because we wanted to. It was a forced change. And now we've got AI coming along, which is probably going to push this even further. So I think there is an argument that, hey, especially with AI and robotics and automation and such, maybe this growth in workers, metric doesn't matter as much as it did in the past. And the market's already recognizing that and moving on.
So baby boomers got the cheapest houses and did the least amount of work. This is something. Y'all are
at least productive.
I know y'all are. This is according to that slide. Not anyone we know.
That's right. Okay, so this was just interesting. Our chart of the week from Exhibit A and showing drawdown frequency. This really surprised me that the S&P 500 has spent about 15% of its time down by 25%. That's not nothing. And people tend to really, that 10% seems to be a demarcation. People start to worry at 10%. We get the first phone calls at 10%. We get the second phone calls at 20%. And it was interesting to me that about 16% of the time it's in a 20% drawdown. I would not have guessed it was that much. So I guess just know that volatility is expected. It is what you need in order to receive a higher premium on your investments, because if you're not taking any risk, why should you get paid more than no risk investments, right? And so this is where the risk is, and it's probably more than what most people assume, especially right now with our recent market performance. Okay, last one on the housing market. This is from Bank of
Chris, I
America.
slipped in one more slide after this one. So
Oh, okay. All right. Sweet. I like it. We'll look at one more after this, but on the housing market, overall housing supply has steadily increased year to date through June. Existing home supply is 4.7 months, which is the highest since July of 2016, and new home supply is 9.8. And we talked about those two numbers in the past, where anything over 4 is and under 9 is considered kind of like an average market, so prices should stay about stable. Versus over 9, prices tend to go down, and under 4, prices tend to go up. And it's we're also living through a very strange time where at least over the last 25 years, this is really the first time that we've seen new homes be there's so much more supply of new homes versus the existing homes. And so it's a very strange real estate market out there. In those terms is just one of the reasons the real estate market is so strange. So having it illustrated like this is an interesting visual.
Daren, is that slide just a graph going up there, buddy?
yeah, just a graph. That's all you need to put up, that graph there. Dan.
Okay, give me 1 second and I'll get that. Vamp. Phil.
All right, I got another dad joke for you.
All right, here we go.
I just built an ATM that only gives out coins. I don't know why no one's thought of it before. It just makes sense.
Chris, somehow I think you like at nighttime you have your big leather chair and the kids are playing around. Like, guys, I've got another dad joke for you.
Yeah.
I feel like it's something like that.
What happened when 2 slices of bread went on a date? It was loaf at first sight.
Oh my gosh.
That's good. That's so good, Chris.
I see the viewer count dropping.
I do see it
quickly.
decreasing. Yeah.
Is this because of the dead air? Or
Yeah, it is. Dan, can you pull up the slide?
I'm trying. It's processing right now. It's thinking about it.
Oh, because you had to re-upload it.
I did. Yeah. So it's I'll get that in there. Do you want to take charts for a minute? Oh, wait, there we go. I got it.
This better be a great chart, Daren.
Here we go.
This is the latest game of Know Your Chart, Chris. Let's see. What chart do you think this is, Chris?
Oh, Palantir?
Not Palantir.
Okay.
Try another one. 3 chances.
Is it more ridiculous or less ridiculous than Palantir?
Less ridiculous.
Is it a single stock?
It's not a single stock. It is an asset.
Oh.
Gosh, I was going to guess Oracle because Oracle had a huge jump this week.
Yeah.
But
I don't know. I'm stumped. Tell me.
Chris, this is none other than the gold chart. So what does it mean? And that's the question I have for everyone. What does it mean when gold is trading like a meme stock? Because the very first guess was you thought it was Palantir, which felt fair, right? You look at that chart and you say, yeah, that looks like a Palantir chart. That looks like NVIDIA. No, folks, that's gold. What is the market telling us when gold is trading like a meme stock? That's the most important question I think everyone should be asking in the economy right now.
Well, Daren, I would say that people are flocking to a known ancient asset because they have fear about what would be happening in the market. But this is where the market doesn't make sense because the market is also not as much, but the market's up this year. It's like 12% this year on S&P. So how are both up?
Well, that's what's so interesting. All asset classes are pretty much rising at this point. And Chris and I were talking this morning, and we haven't had a chance to do any of this research, but we were talking about it'd be really interesting to look back in history at times when all assets were appreciating the way they are right now. Stocks, bonds, gold. And what does that mean? So I don't have a conclusion for this. I think it's pretty interesting. But when you look at the run gold has had, in basically, let's call it a little more than a year. That's bonkers. I mean, you look at this run from right here, which was January of 2024, and now we're in September of 2025, and it's up 77%. Show me someone who would have predicted that. Wasn't it Tom Lee? Right? Gold up 77% in a year and a half, year and 7 or 9 months. That's pretty wild. So market's telling us something here. I think after the fact, it's going to be completely obvious. But I think we go back to the debt conversation we had a minute ago with Chris, where it's like our debt is out of control as a country. And I think we've now proven that we can't stop. We're going to keep printing it. And I think there'll probably come a day when 36 trillion feels like a nothing. But who knows when it ends. Anyway, I thought that was really fascinating. And that gold legitimately.
Part of fueling that gold rise as well is the weakness in the dollar, right?
Right.
And we were talking about that. I think it was last year, maybe the year before, how gold was on a bull run in other currencies, even more so, right? If you were pricing it in other currencies, we're like, wow, gold's up huge in yen or whatever it was at the time. And but the strength in the dollar previously was kind of masking that run in gold. And now that we've seen weakness in the dollar, and that has really made a tailwind for gold investors in US dollars, because you got your dollars are losing value relative to that gold value.
Yeah, that's a great
But I
point.
agree. I mean, it is strange. It's not often that they move together, meaning you know, stock market and gold. And last year was one of the first years that they both moved up as much as they did in 1 year. And you know, just add it to the list of anomalies and things that have never happened before. But we've also never run, you know, fiscal deficits year after year in non-emergency situations like we are now in the past. So we're running a monetary experiment that's never really been tried, especially not on the scale that we're doing it really since COVID.
Yeah, pretty interesting. Nonetheless, let's talk about the S&P 500 for the week. We're looking at the monthly chart. We're going to go to the weekly chart. You know, we've been talking about seasonality for a while in the stock market. The September seasonality, we can see we're right in that September. It's been 2 weeks of green. Granted, we're only 2 weeks into this thing, but we'll see what the back half brings. Been a pretty strong September. You can see back here, September was not great last year. September the year before was red. And we keep cruising back. And for a long time, you can see, I think there was 1 year in here that was green. But for the most part, September typically is a red month. We're not seeing that so far. Month is not over, but you can see on the monthly chart, pretty strong, basically 5 weeks up. Interesting. There is somewhat of a pattern in the market. You can see 1 week candle, 2 week, 3 week, 4 week candles, 5 going up. And on the 6th, we get a red month. And there's somewhat of a pattern there. You can see 1, 2, 3, 4, 5, red, 1, 2, 3, 4, 5, red, 1, 2, 3, 4, 5, 6, red. Then this is a whole mess. 1, 2, 3, 4, 5. So if we're not going to do the down here in September, maybe we do it in October. I would think we get some degree of correction before we go into the end of the year, but who knows? Maybe we're just straight up, straight green. And this was our correction for the year, was the tariff tantrum. Hard to say, but all in all, pretty strong week across the board in the S&P 500. Here's another way to look at the S&P 500, which is a cap-weighted index, meaning the bigger stocks get bigger credit. They move the index. And when you have NVIDIA moving up by 6%, as large as it is, pretty tough to see anything other than green on the screen if Microsoft and NVIDIA are up. But generally, there's some pretty strong green under the hood here. Apple and Amazon, really the only big dogs that were red. Tesla, look at that, 13% up almost this week. What happened in Tesla? I didn't catch that news. You guys catch anything?
Only thing I saw with
No.
Tesla, I think it was last week, was that they're offering to pay Elon $1 trillion.
Yeah.
That was the only thing I saw, because they're
Yeah,
trying
me
to
too.
they're
I
always
didn't-
trying to get his interest, and I'm like, it's his company, so I don't understand that dynamic at all. But that was the only headline I saw.
Yeah, interesting.
Damn, missed it.
Dan, Disney was down by 1.6%.
It has been a rough week, yeah. But you should look at check out Nintendo, buddy.
Nintendo. Oh,
Check out Nintendo.
Okay, we'll look at Nintendo.
It's up 80%.
Well, let's talk Bitcoin. Bitcoin had a nice week. You can see that nice. We're on the monthly. Let's go to the weekly. You can see nice recovery this week. But we're right into this
other screen, buddy.
In the quilt.
Here we go.
In the quilt. There we go.
We're right into this distribution area here as resistance. So we got a breakthrough 116. We break through 116. I think we see higher on the screen. That correction looks to be completed. We'll see how that goes here next week. But we didn't. If we go to the 4-hour chart, you can see traded right into this area here and then sold off. We just closed and opened our next week's candle. Bitcoin, unlike the rest of the market, trades around the clock, and it starts a new candle at 5 o'clock every day on Pacific Coast time. And so now we're into our next candle here. So we'll see how that plays out. Let's take a look at the 10-year. Why the 10-year? Because the 10-year is kind of what everything in the market cues off of. It's a pretty important rate for a lot of economic decisions that happen. And you can see we came right down into this area. I think we talked about that area 3 weeks ago. Do you guys recall? Was it 3 weeks ago?
I think it was.
And
Sounds
we
about right.
talked about how this trend line was support and how we could see a correction down into this area on the 10-year. And sure enough, we found support right in that arena. And, we're holding there. We haven't broke below it. But the fact that it didn't hit that area and bounce like it did over here, you can see if it had hit that area and bounced, that would tell you that support stepped in that part of the market, but it just kind of went into that area. There's a little bit of support. It's still lingering around there. Makes me suspect that maybe it's going to go down further, but you can see a pattern here where it was lingering around and sure enough shot up. But still this triangle is, it's accumulating. So we'll see where that plays out. But Trump and his dudes really want I shouldn't say dudes, Trump and his administration. That's what we call administration in California. We say Trump and his dudes. Would really like for that rate to go down further. Let's take a look at the ag, which is the bond index. Chris, I don't know. If I were you, I'd be feeling pretty good about my bonds right now.
Yeah, they've been looking good, but like you said, that 10-year rate kind of bottoming out. I guess I have PTSD. I don't want to start celebrating too soon.
Yeah, I mean, this nice breakout here came up above, but we talked about last week this neckline, this double top, and then that neckline, and then we broke above it, and then we continued higher this week. Not marginally higher, but higher. Interesting that the ag, the U.S. aggregate bond ETF that tracks the bond market, you can see like it got resistance right on this, which was support. And this is way back in November of 2021. I mean, guys, we haven't seen the ag this high since November of 2021. Where's that applause thing? Dano, can you put the applause on for me? Yeah. I mean, for all those investors that held on.
That just sends shivers up my spine, though, when you start thinking about 2022.
Right. But think about what
think about international. Chris, think about international stocks.
Okay.
You'll feel better.
soothing.
But think about all our investors that are diversified investors, lower risk, that weren't just piling into the tech stocks, extremely frustrated that the market wasn't bouncing like their tech stocks were, and how often we have to say, just, well, if you want diversification, this is how it works. You got to hold it. And, now it's finally getting back to where it was. It'll be interesting to see if we have this like moment, if we do get a correction where rates go down, bonds go up, stocks get smashed, especially on all these high flying tech stocks. And then the bonds just keep rolling. And now we see like a real rotation into bond assets, because anecdotally, people think bonds are trash. But pretty interesting.
When I bring them up to friends at parties, that's what I do, because now I work in this job. I'll be like, well, stocks to bonds, blah blah blah, da, 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 da. And people just glaze over, and the average person, I think, just has no concept that there's this whole thing that's actually bigger than the stock market.
Yeah, it's interesting. I can't remember the last time I went to a party and had someone tell me about their bond investment. I think the only person in the world that might do that would be Chris.
Yeah.
But why you guys never invite me to your parties?
We don't want to hear about the treasury, Chris. Let's talk about oil doing nothing. You know what I noticed? I don't know if you guys caught this, but the CENTCOM commander. So the CENTCOM commander is the most important military figure for the United States in the Middle East, met with the president of Syria and his wife. I don't know if you guys caught that, and how Syria is, like, in a matter of months, has turned into this complete U.S. proxy, which I think is interesting for stabilizing the Middle East, because now you've got Turkey, you've got Syria, Iran just pretty much beat up by Israel, to the point where Israel felt like they could go bomb Qatar and hit the last of Hamas in Qatar this week. So things really calming down substantially in the Middle East, which I think is interesting. What we're not seeing calm down is what's going on in Ukraine and Russia, with all the one-way drones that leaked over into Poland this week. And at least so far, cooler heads have prevailed, but that could be possibly very inflammatory for that area, and could draw the whole of Europe into the war because of Article 5. So Article 5 basically says if anyone in that military pact is attacked, like Poland, then everybody else has to come in and defend them, including the United States. So that got squashed out by the Charlie Kirk news this week, but that came in before, which was particularly, I think, interesting and something to watch. But oil not doing anything, we're just not seeing that impact the markets. So if we look back at all our data that came in this week, I think the real big piece is the core inflation numbers. The market seemed to cue, they like that. Unemployment claims, though, did tick up, and I think that's important to take note of. We've been talking about this for a little bit, but we'll see if that continues to tick up. I wanted to show the yield curves. So this blue one is the current yield curve. This is an inverted yield curve. Ideally, we're looking to see this reinvert. We're still inverted pretty substantially versus 1 year ago. The long end of the rates are going up quite a bit more. But 1 month ago, they're going down. So we're seeing kind of this flattening effect, perhaps, on the rates, not quite as steep on the short end of the rates. The short end of the rates are pretty impactful. This is what the treasury sets in the market, sets the rest. But if you look at the 10-year right here, this is what we've been watching, is that 10-year rate. But really, you don't want to see this curve in this curvature. We want to see it the other way around. So all in all, pretty good week, pretty good 2 weeks for September. I think we can feel positive about that. I'm not smelling anything really awful other than we're still faced with seasonality. We still got 2 weeks to go in the month, and seasonality could play its role, but we will see.
All right. Well, it was a tumultuous week, and the market didn't necessarily react how you would expect it to. And so looked at today, perhaps some of the reasons why, and we look forward to a new week next week. So we thank you for checking out the show wherever you are. Make sure you subscribe and make sure you follow us so you can get more of our updates. And we will catch you next time. Daren and Chris, thank you so much.
Thanks, Dan.
Thanks, Dan.
You're up to date with Fermata on the markets. Learn about how the Fermata Advisors family of brands can help your family and business in finance. Sonoma Wealth Advisors, a comprehensive, holistic finance solution offering financial planning, asset management, and tax planning. Take our free wealth analysis now at sonomawealth.com. Fermata 401k, business retirement solutions for small and large companies with a fiduciary commitment. Learn more at fermata401k.com. Fermata Tax, personalized tax services for yourself, your family, or your business with an emphasis on efficiency. Find out how at fermatatax.com. Fermata Insurance. Appropriate insurance is an important part of a financial plan. Find out what coverages you may be missing at fermatainsurance.com. If you haven't already, like and subscribe to Fermata on the Markets on YouTube, Spotify, and Apple Podcasts. Fermata on the Markets features human hosts, editors, and voiceover talent. Music by Dr. Delight on Soundstripe, voiceover by Joan Alloway Nash. Thank you for listening to the very end. We appreciate diligent viewers and listeners. Fermata Advisors LLC is registered as an investment advisor with the SEC and only transacts business in states where it is properly registered or is excluded or exempt from registration requirements. This content was produced by Fermata Advisors LLC, DBA Sonoma Wealth Advisors, DBA Fermata 401k, DBA Fermata Tax, DBA Fermata Insurance. The opinions expressed by Fermata Advisors LLC on this show are their own. Information presented on this program is believed to be factual and up to date, but we do not guarantee its accuracy, and it should not be regarded as a complete analysis of the subjects discussed. Discussions and answers to questions do not involve the rendering of personalized investment advice, but are limited to the dissemination of general information. A professional advisor should be consulted before implementing any of the options presented. Information presented is for educational purposes only and does not intend to make an offer or solicitation for the sale or purchase of any specific securities, investments, or investment strategies. Investments involve risk and, unless otherwise stated, are not guaranteed. Information expressed does not take into account your specific situation or objectives and is not intended as recommendations appropriate for any individual. Viewers and listeners are encouraged to seek advice from a qualified tax, legal, or investment advisor to determine whether any information presented may be suitable for their specific situation. Past performance is not indicative of future performance.